What is price stability in inflation targeting history? Imagine trying to plan your finances when prices are jumping around wildly. It would be tough to save, invest, or even buy groceries. That's why central banks aim for price stability. But what does that really mean? Well, in inflation targeting, it means keeping inflation low and steady over time. Usually, they aim for about 2% inflation each year. This small increase helps prices stay predictable, so everyone can make better decisions. The idea of controlling inflation has been around for a long time. But it was not until the 1990s that countries started setting clear rules for inflation. New Zealand was the first in 1990 to officially adopt an inflation targeting system. They set a specific range, usually between 1 and 3%. Countries like Canada, the United Kingdom, and Australia followed soon after. They wanted to make sure prices didn't rise too fast or fall too low. Why 2%? Well, a zero inflation rate might sound perfect, but it can cause problems. If prices don't go up at all, workers might struggle to lower their wages without losing income. A small positive inflation rate makes it easier to adjust wages and prices smoothly. It also helps prevent deflation, which is when prices fall and can slow down the economy. Having a clear inflation target also helps people trust the central bank. When everyone knows what to expect, they can plan better. Central banks use tools like changing interest rates and buying or selling government bonds to steer inflation toward the target. They also share their plans openly to build confidence. This transparency makes markets more stable and reduces uncertainty. Over time, inflation targeting has become the main way central banks focus on price stability. Many countries now see it as their top priority, sometimes even more important than employment or exchange rates. For example, the European Central Bank aims to keep inflation below 2%. The United States Federal Reserve adopted a 2% inflation goal in 2012. So, in simple terms, price stability and inflation targeting means keeping inflation low and predictable. It's about making sure prices don't jump around too much, helping the economy grow steadily. This approach has changed how central banks work, making their goals clearer and their policies more consistent. It's a way to keep our money safe and our economy healthy over the long run.